I think it was interesting in the Fed vote today, there were two dissents, and we have not had two dissents since 1993. And I remember those because I was in the business back then as well. And I think that's very important symbolically because Chairman Powell has wanted unanimity. And so now we've had a break. And part of it is because Chairman Powell's term is up in May.
Cathie Wood reaffirmed her bold prediction that Bitcoin could eventually climb to $1.5 million, linking this outlook to the growing role of stablecoins in driving broader adoption. While her long-term perspective remains decidedly optimistic, the near-term environment appears more uncertain. Recently, Bitcoin's price slipped below $113,000, registering its sharpest monthly decline. Traders are now paying close attention to the so-called ghost month, a period historically associated with major pullbacks. Previous cycles saw drawdowns of nearly 23% in 2021 and as much as 40% in 2017. For the first time since July, the daily chart has flashed a bearish engulfing pattern, underscoring the pressure on bulls. The critical task ahead is to defend the key support zone around $117,000, a level that could determine whether momentum stabilizes or further weakness develops.
Of next year, and maybe the two governors dissenting want a shot at that position. You never know. You never know. But maybe it is because the two governors, and I haven't gone through all of the notes yet, the two governors are seeing evidence of housing relapsing here and prices in many areas not responding to tariff increases and seeing that, well, wait a minute, maybe the surprise here in the next 6 months is going to be much lower inflation. And we've had a few employment reports that they have something for everyone, some strength, some weakness. But I think what's beginning to concern a lot of people is that the unemployment rate for new college graduates is going up. And that's because entry-level positions are being subsumed in many cases by automation, especially AI. And so I think they're looking at this as a potential concern out there. We have been saying for quite some time that the economy has been in a rolling recession. When the Fed jacked rates up 22-fold in little more than a year's time, one sector after another began to give way, starting with housing. Housing, by many measures, is down 35% still from the peak. And we're seeing some metrics take another step function down. So I think that has some people concerned. I think the housing inflation numbers are going to come down. They're already, the monthly numbers that we get from various sources are showing declines. Year over year, they're not declining, except for maybe median existing home sales. But we do think that one of the solutions to the affordability crisis, if sellers really want their homes to move, they're going to cut their prices. And because that is if interest rates don't come down. And if they do cut prices, then the big surprise in the latter part of this year is how low inflation is going to go. And there's a big lag between the time home prices fall and they get into the statistics and leave the statistics as well. So this is going to be with us for quite some time. So I think we've been saying we believe that thanks to certainty now, more certainty about tariffs, tax policy, government spending, and regulation or deregulation, that we're getting ready to move from this rolling recession into a much stronger than expected recovery. In the next, I'll say 6 to 9 months, it will become obvious. With productivity, one of the biggest surprises, it's already strong given the slow growth rates in the economy. I think year over year it's still up above 2%, but we think it's going much higher thanks to all of the technologies around which we have centered our research. So robotics, energy storage, AI, very importantly, blockchain technology, obviously important here, and what we call multi-omic sequencing in the life science space. All of those innovations are incredibly deflationary. And the best example probably is AI. AI training costs are dropping 75% per year. AI inference costs, so the cost to get an answer as we're typing into ChatGPT or Grok, my preferred right now is Grok, those costs are dropping anywhere from 85 to
Indicators of demand suggest that dip buyers are once again turning their focus back to the market, even as selling pressure builds. In the U.S., strength is apparent through the Coinbase premium, which has climbed to fresh monthly highs. Over in South Korea, the kimchi premium has flipped back into positive territory, signaling renewed enthusiasm from local retail investors. This sentiment is further reinforced by stablecoin inflows. Following the recent pullback, more than $3.8 billion worth of USDC has been transferred to exchanges, a clear sign that traders are preparing to accumulate digital assets. If historical patterns hold true, Bitcoin could still advance toward the $118,000 zone before initiating its next decisive move.
China, we've gotten a statistic 98% per year. So when you cut the cost of something, you get a lot more of it. So we think this is good deflation. This is not deflation like 08, 09. That was very bad deflation. This is good deflation for those companies that are on the forefront of these new technologies. It might be bad deflation for companies that are going to be disrupted. And if they're being disrupted, they'll be forced into cutting prices as well. Mm-hmm. So we think we're going into a much more deflationary world than I think many economists and strategists would suggest.
Talk to me about that 6 to 9 month outlook. Where does crypto fall into your vision for a stronger next 6 to 9 months?
The regulatory environment is very important here. We've gone from a hostile regulatory regime under Gensler at the SEC to a very, very friendly regime now, with legislation guiding regulators instead of regulation through enforcement, which was forcing innovation off U.S. shores to other countries. Now that's changing aggressively, especially appointing David Sachs, the czar for both crypto and AI. And this concept of agentic AI coming into view where, we will have our AI do all the walking and working and talking for us, up to a point, right? Because of agentic AI. And we need smart contracts because these agentic AI, our AI agents or assistants are going to be interacting with sites, maybe like CoinDesk, that, where we'll need to pay some money for something, one thing or another. And these are going to be automated smart contracts. Well, agentic AI is going to make that happen. So this is the convergence of AI and blockchain technology. But before that, what we're also seeing is a revolution in financial services. Thanks to the green light from regulators, more financial services companies are moving into the blockchain world because they realize it's much lower costs. So as I explain to our clients what's going on here, I like to back up because I remember this time very well. In the early 90s, late 80s, early 90s, when developers were first working on the internet, there was no idea that financial services or commerce would take place on the internet. And therefore, there was no payments layer. Now, thanks to blockchain technology, we have the payments layer. over the last 30, 40 years, because we didn't have the payments layer, we needed to, and because financial services and commerce did migrate onto the internet in a very big way, the traditional world had to mitigate the risk of putting credit cards online and, trying to use traditional financial tools in this internet world. And all of the intermediaries involved have been taking anywhere from 2 to 3.5% out of each transaction paid for mitigating the risk. We can probably drop that, and that's a tax on the system, right? We can drop that tax from 3.5%. These are US numbers. In Nigeria, the numbers would be 20% or more, right? Drop